Hey everyone, welcome to today's ICT Applied Concepts. Today we will be looking at the S&P 500 futures chart, studying price action and see if we can find a possible entry. Let's start right away by looking at the charts. On the left we have the 15-minute and on the right the 1-minute chart. I like to split the screens like this so I can see what is going on, both on a longer time frame as well as on a lower one. On a higher time frame, it gives me a zoomed-out view, more of a bigger picture. And on a lower time frame, for more temporary formations, such as fair value gaps, which allows me to see a possible entry. But I usually start with even higher time frames, such as daily and 4-hour charts. I do this to find any significant areas, typically fair value gaps and liquidity pools. In this case, we have only one, and that is the bullish fair value gap, which is marked out down below and is from the hourly time frame. Then I have marked out several other key areas. Cluster of new day and week opening gaps. As mentioned in one of my concept walkthrough videos, these gaps are a kind of liquidity voids and the algorithms tend to draw to these areas and engineer liquidity. Here, for example, a double top was created and which was later swept. This shows how important it is to mark these out on your chart. In this example, the reaction to these gaps are not very explicit, but there are other examples where the reaction is a lot more distinct. Moving on, we have this 15-minute liquidity pool, which formed just outside of the screen. And then we have these 3 bullish fair value gaps, which formed after market opening, and we will address them later. So we see here that the market has reasons for both going up. To the 15-minute liquidity pool, it could also go down to sweep these intermediary lows, which will also have liquidity resting just below them, as well as going even deeper to this hourly inefficiency area. So what I like to do during times like this is to allow the market to show me some structure and show me its hand before I form any opinions about possible entries. ICT says that beginner traders should not make any trades before 10 a.m., as to not get caught up in the initial volatility during market open. This is good advice, but you need to be flexible, as sometimes big moves start before that. Like in this case, where the move started around 9:45. So what we see right after 9:30 market open is that the market goes down to sweep these aforementioned lows, indicating that it wants to go lower. However, it is important to remember the power of 3. Where the market initially goes in the opposite of its intended direction. So, the key here is to stay patient as to not get into a trade on the wrong side and wait for the market to tip its hand. And as we can see, the market goes down, tips its toes into the hourly fair value gap before it then reverses and goes back up. And this is the first leg of power of 3, the manipulation going down. Taking the pools of liquidity, accumulating long positions, finding a pivot point, in this case this hourly fair value gap. Before then it can go up and distribute them to a liquidity pool somewhere above. As it goes up, we see that it creates multiple bullish fair value gaps. However, note that even though you might be able to predict where the market is headed to, that does not mean you can enter a trade. You still need to find a good entry point. So you need to stay patient and wait for the signs. The first sign that I can see is that it first broke a previous intermediary high. Then it retraced a bit until it entered the lower end of an inversed fair value gap, and this is where I entered this hypothetical trade. However, even though I was quite patient, waiting for the market to break its downward structure and retrade into an inverted fair value gap, I can also see that, not much later, the market traded into the topmost fair value gap, as well as touching on the upper end of a bullish order block. This illustrates how important it is to be patient, and even if it means you will miss a trade, it is better to not be in a trade than being on the wrong side of a trade and lose money. As ICT usually says, the market repeats itself, so there will always be another trade. But moving on. I set the stop loss of the trade at the midpoint of these 3 bullish fair value gaps. The reason for this is that if you have multiple fair value gaps for which the market could trade down to, then you should expect that it could revisit all of them. So your stop loss should take that into account. In this case, I felt the market was really bullish, as indicated by this strong displacement up. so I felt that it would be enough to set it at the midpoint of the second one. Next, I set the take profit level at the first significant resistance level, and in this case it is the first high on the 15-minute chart. Notice, though, that its final target seemed to have been that same 15-minute liquidity pool, which I mentioned earlier. Further note that the drawdown is going down to the upper level of the bullish order block. For me, these kind of details are important as it really shows that these points are significant. Also, the way the market moved today, going down and reacted to the hourly fair value gap, where the algorithms can buy longs at a place of discount and then sell short at a place of premium, shows how the market fundamentally works and is the same basics as any sound investment strategy, which is to buy low and sell high. And the way on how it delivers that is by applying strategies such as the power of three, which is about manipulating others to trade on the wrong side, so that it can consume their stop losses and accumulate trades, which it then distributes in a favorable place. Understanding that and learning the signs that it leaves, such as fair value gaps and liquidity pools, is the key into understanding the market and executing successful trades. So, as always, I hope you found this video useful, and if you did, then please leave a like and subscribe. And I will see you the next time.